Hello, everyone. Today is Friday, December 2nd, 2022. My name is Evan. Welcome back to another edition of Stock Market Weekly, episode 660, presented by the Trade Risk, where it is our job to break down the most important trends, price action, and noteworthy moves across financial markets. If you're brand new to this video series, first off, welcome. Thanks for being here. Thanks for tuning in. Here's how these videos work. We break up our analysis into two parts. In part one, we look through the numbers and pick apart everything that stands out, looks different, interesting, or notable. And then in part two, we jump into the charts. We take a close look at price action and measure those greater market trends to best position ourselves looking ahead. So hopefully that sounds good to you. Let's jump into some of the headlines and some of the discussion here that we're going to talk about in this week's video. Most importantly is we had the market launching higher here post Powell speech on Wednesday. So the market was sort of drifting lower, a little bit defensive, risk off, easing into the speech on Wednesday. And that was the fuel. That was sort of the offsides, immediate market imbalance to springboard us higher. We had Powell coming out with slightly more dovish tone, less aggressive stance on future rate hikes, potentially, even slowing or moderating what is to come here. And that was all the market needed to kind of push higher along with that positioning. We had another of, interesting technical developments this week as well. We had the US dollar breaking below dollar index, breaking below the 200 period simple moving average. And this is the first time in about a year that the dollar is back below the 200 SMA. It's sort of, accelerating its pullback from those all-time highs, or those 52-week highs, multi-year highs. But that's something we're going to talk about in part two. We have Treasury yields, which continue to fall. These two things certainly helping support the equity market trade, the equity market rally. We have the VIX below 20. It's been a long time since that's happened. It's near its year-to-date lows, and we're going to talk about that in part two as well. And the question we should be asking ourselves or thinking about here is this a new regime shift here? We've got lots of broader, longer-term trends. The things that have been in place are starting to shift on these bigger scales. And so the question we are asking ourselves here is this the new regime, the new normal, or is this going to be the best short selling opportunity that we've seen in 2022, right? Where are we going to fall? And we're going to talk about that in part two. Okay, so let's get into it here by the numbers. S&P 500 up 1%, Nasdaq up 2%, Russell up 1%. World stocks continue to do pretty darn well here on a relative basis, up 2.3%, up 14.75% in the past month. So the best place to be has been outside the United States, in fact, and that is continuing to work, at least the ACWX index. There's lots of ways you could slice the index, but everything on the week here was green. Everything over the past 1 month strongly in the green as well. Now, if we look at these trends, we talked about this last week. 10-period simple moving average, that's been rising for a while. The 50 SMA started to rise in all of the major U.S. indices last week, and we are seeing that continue. We still have a declining 200 SMA, but the short and medium-term trends are now definitively on the rise. Now, if we take a look at volatility here, this has been the bright spot absolutely here. 19.07 here for the VIX going into the weekend. It was at 20.5 last week, so it's down another 1.5 points. Nasdaq falls below 25. Russell 2000 volatility is below 25. So this is getting into that sweet sort of trending spot. There's less risk, more kind of structural support here, I think, for the market to continue the trend higher. Now, we're going to talk about this in part two. If you haven't hedged, if you need some hedges, if you're worried about the market, if you're worried about the future, skew is pretty low right now. Volatility is pretty low right now. This is the time where you may want to consider those hedges. But again, we'll talk about that in part two. Now, 52-week highs and lows, something we closely monitor here. We're starting to get more highs than lows. That is a fact. So we had on the week here about 110, a little over 100 stocks net advancing or net making 52-week highs versus those that are making lows. It's still not that exciting of a number, though. I mean, we still aren't really expanding and broadening out to triple digits, multi-hundreds each and every day to the upside. So we're still sort of waiting for that big breath thrust, that expansion of stocks hitting 52-week highs. It's at least encouraging here, but this has been slow. We are 15% off of the highs. Off of the lows in the major indices, and we're still seeing a balance here of highs and lows. It's a little bit disappointing, but again, it is slowly improving. Now, if we look at sector performance here, it was pretty supportive here across the board. Consumer staples, though, was at the top of the list, 4.47%. So again, fairly defensive tone there. Discretionary, though, was the second best performer, 3.66%, and then communication services at 3.5%. On the downside, energy continues to take a beat here, about 1% to the downside. So this has been starting to moderate quite a bit over the past month or so. And this, again, has been the strong leader. So again, take a look at the 1-year performance for energy, up 72%. And over the past 1 month, it's basically flat, while the rest of the market is starting to do some lifting to the upside. Financials, second worst performer. Utilities, third worst, but positive on the week. Now, if we take a look at industries here, so this is our good sponsor over at Investors Business Daily. They generate these data tables every single night, and so we're taking a close look at what industries are leading the market. And we still have, despite this last look here at energy slowing, we still have energy dominating the top of the industry ranks, but we are getting some things that are changing, right? We've got, for instance, the number 8 spot this week is food and dairy products. And so if we look 3 weeks ago, it was the 88th industry in terms of leadership here and in terms of strength. And so it is climbing pretty aggressively. And so you can see that. You see retail as well, creeping into the 10th spot. 3 weeks ago, it was the 90th spot. So we do have some things starting to break in here to this energy leadership, but we're going to continue to monitor that. You can subscribe to these data tables with a link in the description of this video, and it's right here on the left hand of your screen. Now, if we push forward here to correlations, you can see correlations are still kind of the same old that we've been looking at here. There hasn't been a whole lot of change, a little bit of broadening out, or I guess loosening of these correlations, but still, we've got basically the indices, which are almost all trading in lockstep with one another. We still have that strong inverse dollar correlation. We still have the strong yield correlation, 10-year yield to what's going on. And these are both inversely correlated, as they have been all year long. Bright red, risk on when the dollar is falling, when yields are falling, risk off, vice versa. So that is pretty much there, and feel free to look through the rest of this. Remember, 10-day correlations, they are pretty short term. Now, Treasury yields, again, as we talked about, really continue to pull back and unwind a bit. We see the 10-year yield at 3.5%. It wasn't long ago where the 10-year was north of 4%. And now, even last week, it was 3.69%. So we are still falling at a pretty aggressive clip here. And again, that is certainly what is supporting some of this equity market rally. Good to see yields down. At least even consolidating sideways is fine, just not ripping to the upside as we've talked about repeatedly. Now, dollar and commodity performance here, we had silver at the top of the list. Silver and copper up 8% and 6.5% respectively. Both of those have put in a great 1 month window of returns here. 18.67% for silver. Copper is up 13% over the past month. That's pretty strong returns in both those commodities. Crude oil was up 4% this week. It's still down 4% on the month. It's still kind of in a choppy bit of a range, but positive week for crude oil. Bitcoin was up 3.5% despite, terrible headlines and bankruptcy filings and court proceedings and all this disastrous headlines. We've got crypto, which is stabilizing or trying to rally. Gold was up and everything else was down. So ag was down a slight bit there. DBA down 0.05%. Dollar index was down big, 1.74%. It's a big weekly move. And natural gas, huge loser this week, minus 16%, 15.95%. Notice, though, on the month, it is flat. So that goes to show you how volatile this is and how much of a sort of vertical ascent it was on earlier this month. So that is quite the unwind there for natural gas. Last but not least is our positioning here. Very, very quiet neutral here. So we run two trading systems. Our first system is Merlin. It's a longer term system, and it is about 18% invested into this market right now, still in a pretty defensive tone and not really out there aggressively adding risk just yet. And our short-term system is short the market right now, 17.5% positioned on the short side. Together, they're about flat, 1% to the upside here. So really, when we look at our two models here, our two quant models across different time horizons, we are pretty conservative on both fronts right now, and we're just waiting for the market to maybe catch its breath a little bit, stabilize a bit, and just kind of cool off, and then look for some new opportunities, let's call it. So we've got a lot more information about these two very rules-based trading systems. We've got a $1 trial available, so head to thetraderisk.com/trial. You can check out and learn more about these two trading systems. And that concludes part one. We'll be back here in just a second with some charts. All right, we're back. We've got TC2000 open, and we are looking at our cash settled market of the S&P 500. This is where we're going to start our analysis this week. And this is the sort of roadmap, the grid, the view that we've been looking at for the past many months at this point. And we've been kind of staring at these big horizontal key inflection points and key areas of where the market has been responding pretty cleanly and neatly at. And so when we zoom in here and we look at the price action and we look at where we have come from and where we just moved from this week, last Friday when we did our video, we were right up here going out towards highs, trying to push above the highs from Tuesday the 15th. And basically, our assessment at that point was short-term trends, medium-term trends were up. We were giving the benefit of the doubt to the buyers because we do have a series of higher lows and higher highs here, and we are holding above 3,900. This has basically been kind of the key area that I've been looking at and saying, look, if we're above 3,900, we want to at least be optimistic on this market. We think that a reasonable target, which we've had now for a few weeks, is up around 4,100 to fill this gap. And lo and behold, this week, not without some struggle here, we got there, but it took this Monday and Tuesday of this week of a bit of a tree shake here as markets gapped down and basically sold off pretty aggressively on Monday, and then they kind of just meandered around on Tuesday, kind of anticipating waiting for the Fed. And then of course Wednesday was Fed day, where we got that slightly more dovish rhetoric out of Powell, or at least just not as hawkish as what I guess the market was fearing that he might say, and that was enough to catalyze us to the upside. Of course, with low liquidity environment right now, we've got month-end numbers, lots of things kind of, fitting into the overall kind of landscape of where we are. But ultimately, we drove higher, 3% up day, heavy volume, right? So a couple of things to note here in terms of volume. We have seen basically now over the past month, all of the highest days of volume have all been up days for the market. And so what we're basically getting is a stampede, this flood of volume and liquidity that's coming in, driving prices higher. And then the market goes through these slow, low volume consolidation periods. I mean, look at the low volume in here for most of November. For basically the second half of this month, we treaded sideways as volume just declined off a cliff. But if you look at it in context of where we were, it was following a big move up and then holding above the key support. So, when we look at this volume profile, it's actually quite bullish here. Even though it has been light, it has been all large volume days on the move up, breaking through resistance, and then low volume consolidation is pretty much what you love to see from a classical TA perspective. And so when we look at where we are now, we had this big drive up on Wednesday. We consolidated Thursday. We did have a knee-jerk gap down reaction on the jobs data on Friday, but buyers seem to kind of come in here and stabilize us and buy up this dip, and we closed the day towards the highs. So when I look at the kind of roadmap of where we are. We're butting our head up against this 4,100 resistance. We did fill this gap in here. And if we zoom out even further, we're starting to come into some more significant overhead supply from earlier in the year and the prior peaks up here from the summertime. So this is where things get much more dicey, little more cautious here on the market than I was, back in here while we were consolidating. And this seemed to be a clearer, easier road to kind of stay on the long side. And as we are now another couple of percent higher, we're now approximately 17% off of the lows. We're now in a VIX under 20 environment. This is where things get a little more tough, I'd say, to stick with the long side. Now, the question we posed at the top of this video was, is this a regime shift where we're starting to enter into a lower volatility environment that is kind of synonymous with healthy uptrends or constructive uptrends? Or is this where, we're really washing out and squeezing out the rest of the shorts here, and we're about to mark some more significant top and start another leg down similar to August or even, June of 2022, right? So that's what we're kind of keeping an open mind and thinking about here. And we have to straddle the evidence in both directions. So the way I'm approaching this is to basically stick with the uptrend here, because the trend is definitively up on the short to medium term horizons, the time horizon that I'm looking at. And so I do want to give the benefit of the doubt to the buyers still, but I do want to be conscious of risk up here. I want to be taking profits. I want to be hedging if that's appropriate to my strategy. And I want to be thinking about protecting myself from the downside or some type of rug pull here. But I do want to participate in the long side. I don't want to get too early in fighting here. So that is what we just want to be very, very cautious of. So for me, I'd love to see conviction in a move over 4,100. This is pretty stiff resistance here, and I want to see how the market reacts. Can it get a couple of closes above here? Can it start to march up towards the summertime highs? I think if we can clear above 4,100 and do it, with some consecutive daily closes, or just show some price acceptance over 4,100, then yes, I do think 4,300 gets pretty quickly up in line here in favor. Really up here is kind of that last big zone that we were identifying up around 43, 42.80 or so. That's what I'd be looking at as a next target, as a next possible destination for this market. That's approximately 4.5% above current prices. So that's really kind of the roadmap I'm looking at here. If we fail at 4,100, if we start to see this volume profile shift where we start to get some big volume days that go nowhere, if we get some dojis with some heavier volume, or if we start to get more distribution like signals here, that's where I would be, just really keeping an open mind and eye out for to change my tune, to change my analysis, to prep for maybe some type of more meaningful pullback. So that's kind of how I'm looking at things. I'm pleased with sort of the rally and, the move that we've seen here. And now I just want to be a little more cautious. That's the way I'm thinking about it. Now, if we look at the Russell 2000, Russell 2000 has been lagging a little bit, and we've been talking about how we haven't been that excited about the Russell 2000 over the past month or so. We've been really kind of focused on S&P 500 and then potentially a Nasdaq catch-up play. Russell still kind of treading water here. It's slowly, it's grinding higher, but it's still sort of lagging in terms of these other major indices. It does have some significant, area in here. This 190 zone has been an important market, an important zone for the Russell 2000 for quite some time. And so you can see it's kind of grappling with this right now. I think if it can punch through 190, it has some room. It has plenty of room actually into all the way up to the 205 and even 210 area, which was the big breakdown zone from January of 2022. But we're not there yet. And so we want to see how it reacts here. It is definitely slowing down. You can see the volume has been light minus Wednesday. And so let's see how it handles this 190 and kind of take things from there. If we look at the Nasdaq 100, this here, again, as we've been talking about, this was the most sort of, dangerous market here as it was just holding and really kind of breaking at times here below this band that we've been looking at, this lower 280s to mid 280s of where we wanted to see this hold above the October highs. And you can see it basically, found support there on Tuesday, Wednesday, and then punched through it on Wednesday. And this does look more powerful, more primed than some of the other markets right now. It is lagging. Absolutely. It is lagging on a relative basis to the uptrends that we've seen in the Dow and the S&P. But it does have a fairly constructive looking consolidation pattern that it is just trying to emerge from here. And if it does punch through this 296 zone, just like the S&P 500, I would not be surprised to see it come in here and fill the September gap up around 309 or so. So for the Nasdaq, you might get a little more juice out of this, but it's about 4.5% or so, which would coincide with that S&P level that we just looked at in terms of a price percentage magnitude, about 4,200, 4,280 in the S&P 500. That's about 4.5% above us. So perhaps we get another extension in both these markets, the Qs up to the September highs, gap fill, and then the S&P 500 into the August highs. So that's the way I'm looking at things. I think the levels are clear regardless. Below 282, below Wednesday's low in the Nasdaq 100, all bets are off. Then that's a change of script. That's a change of character. If we start breaking down here, if we start losing 280, much more cautious on the market. Same thing for the SPY. If we start losing below Wednesday's lows, 394 or so, if we get a reversal in character here, some high volume and a kind of thrust off of these highs and a breakdown here, that would get me certainly defensive, outright bearish on the market. So that's the way I'm looking at things. If we take a look at volatility, we talked about this at the top of the show. Look at this just cliff dive in VIX here, below 20, back below the August lows, almost back at year-to-date lows. So we've seen a wonderful kind of, unwind here in fear. And so we're going to keep an eye on this, and we're going to, love the fact that we're below 20 for our bullish positions, but we do want to keep an eye on this and just remember and understand the path that we have just taken here. This was a great move lower in the VIX. We got a lot of positive, momentum there in the S&P 500, Dow Jones, and equity indices. But now we just want to be careful of too much complacency. Same thing with the dollar, right? The dollar is now below. Let's see if I can put the 200 SMA on. We don't look at the 200 SMA too much, but there it is, this yellow line. First time it is tagging it back below it since June of 2021. So it's been a very long time. We're about 10% off of the highs, or 8.5% off the highs in the dollar index here. And we just want to be cognizant of that. The dollar is a wrecking ball, and it can really cause lots of headwinds for equity markets if this catches a bid, if this starts to find some support, and if folks, kind of come back in here and look at the dollar as being sort of the safety asset to hide out in more, sort of turbulent economic times. So let's keep an open mind about VIX trajectory, dollar trajectory lower. And then if we look at TLT, for instance, look at the continued acceleration here, 16% off of the highs for TLT, coming back to the summertime lows nearly. And this has been the strongest move off of the lows rebound rally that we've seen all year long. You can look at the IEF as well. Or even just frankly look at 10-year yields, and you can see them coming back down to multi-month lows. So all of this has been very supportive of the market, and you got to ask yourself here, and you got to think about your time frame. Everyone's different that's watching this video. Is this the new normal? Is this a new regime? Are these the new trends that are in motion the other direction, which is going to pave the way for maybe more pleasant long ideas for the next couple of months? Or are we getting too complacent here in a ugly kind of next 6 month economic environment. So that's the question I leave you, and I want to know in the comments below which way you're leaning here. Are you looking at this market to continue? Do you think we're at the end of a bear market bounce or a regime shift? Leave a comment below. My vote is I want to continue to participate on the upside in equities, but I do want to keep a eye open on risk here. I do want to put on some hedges. I do want to just keep the risk as a open mind factor as we head into the new year. Remember, we have lower volumes right now, and we are going seasonally in a fairly constructive bullish period. So, if we do get another push higher in equity markets here, that would line up going into the next couple of weeks. And then maybe that is, again, where you want to start to think a little more defensively. So that is what I got for this week. Please have a wonderful weekend ahead. Thanks as always for tuning in and watching, and do let me know your thoughts in the comments below. Would love to hear kind of what everyone is thinking about heading into the last month of the year. So take care. Good luck out there, and we'll see you back here next week.